All right, folks, welcome to Investing for Beginners podcast. Today we have episode 368. We got one great question from Stephen that we're going to answer. But before we do that, we're going to kind of lay a little groundwork to lead up to the question. So what we're going to talk about today has to do with valuation and stock-based compensation. But before we get to stock-based compensation or the dessert, we're going to talk about a little bit of veggies and hopefully some protein and maybe a starch. So with that, let's dive into valuation, maybe from a 30,000 foot overview. What is it and why is it important?
Basically, the very, very basics is when we buy shares of a stock, we're buying part ownership in the business. So we're not trading little pieces of paper and gambling. This is part ownership stake in the business. And so every business in theory has a value. It has a particular worth. And so what any business is worth is what valuation is trying to describe. And so if we know what a business is worth, we can know whether buying a piece of a business is fair or a good price or not. And that can help determine how much return you make on a stock when you buy and sell it. How do you kind of look at valuation? And what helps you think about valuation when you're buying a stock?
I think it's critically important, and the price that we pay matters a lot. And I think we need to be cognizant of that. And I try to think of it like you would buy anything else, whether it's a car, a house, a guitar. You're always trying to find the best price you can for that particular asset. And the same applies to buying companies. As you said, we're buying a piece of that company. We're unfortunately not wealthy enough to buy the whole company, but we can buy a piece of that company. And when we buy that piece of company, part of the way that we get a good return on our investment is the growth and the value of that asset or that our piece of the pie. And so the better price that you pay, the longer you hold the company, the better chance you have of having a better return. And that's what we all want. And, going back to Warren Buffett, as always, he likes to say that he likes to buy his stocks the same way he likes to buy his socks when they're on sale. And I think that really just kind of says it all when you're thinking about valuation and when and how do you buy a company. That's, I guess, how I try to look at it.
That's great. Yeah, that's awesome. Nice quote, obviously.
Yeah, right.
So how do you do valuation? Who sets the rules and how is it done?
Well, as far as I'm concerned, Michael Bovason and Professor Oswald Damodaran set the rules, and we just have to live in their world and follow them. I'm kind of kidding, sort of. There's a myriad of ways that you can go about valuing a company. The most common, in not only in the layman's terms, but also in professional investors, is using things of that nature are great shortcuts to value companies. And then the other ways, the ones that you and I like, are discounted cash flow models. And those are ways that you can kind of use to project what the future cash flows are going to be and then discount them back to the future or to the present. And then that's how you can kind of try to figure out the value. It sounds a lot like voodoo. It's not. There's not a lot of inputs that you need, and they can be very helpful, especially for different, for certain kinds of businesses. They can be probably the best way to value them.
Yeah, totally.
So what are your thoughts on valuation? Like, how do you think about how do you value a company?
Yeah, there's two separate approaches. There's the free cash flow to the firm and the free cash flow to the equity. One's looking at the income statement and balance sheet, and the other one's looking at the cash flow statement. So I've gravitated towards the free cash flow to the equity model, which looks at the cash flow statement, and have been using that for over 4 years. And so I feel that I've gotten pretty familiar with what makes that model tick. Where are its flaws? Where are its advantages? And how can I use that for myself to make myself a better investor. So for me, that's been a helpful model to learn.
Yeah, it's a great one. I have veered more towards the free cash flow to the firm model, which, as you said, focuses more on the income statement and the balance sheet. And that is the one that I have chosen to use. But I have different models for different kinds of businesses. And so it maybe is not as useful in all situations. And that's something you have to keep in mind when you're using these tools is they're tools and you can't use them for, it's not going to fit for every single thing. It's not like the man with a hammer going around looking for every nail so they can pound something. I like the free cash flow to the firm model because it really boils down to the operational efficiency of the company and the revenue growth of the business and how well they invest. And so those kind of, to me, are three of the main areas that I try to analyze when I'm looking at a company. And I think a big reason why I do that is because I use those models to value the company. And so it makes sense to try to think deeply about the inputs that are going to go into the model. So maybe you could help educate me a little bit on the free cash flow to equity because I'm not as familiar with it. So could you kind of lay out what is the basic structure of how that model works and what would be some of the main inputs you would need to know?
The inputs are pretty simple. You have a free cash flow per share input. You have a growth rate of that free cash flow per share. Then you have the discount rate that you're discounting it by. So I guess where I start to veer off course and get fancy is I like to play with the free cash flow number as my input. But I believe strongly that that's a very important thing to do if you're going to do a model like this. And I know Domadoran off and on also mentions you got to normalize working capital and things like that. And so what you will see in the cash flow statement is depending on what year you're looking at, there might be a lot more variation in the numbers just because of the way cash might happen to go in and out of a business in any given year. And so I do try to normalize every number that goes into that free cash flow because the free cash flow formula is simple. It's cash from operations, subtract capital expenditures, and that's your free cash flow. But all the other parts that make up that cash from operations do need to be adjusted. So if there's an inflow in cash from deferred taxes that they were supposed to pay taxes on 2 years ago and they finally paid it, and so we have an outflow or an inflow of cash, that's not going to happen next year probably or the next 10 years. So you have to adjust the free cash flow number for that. That's what I do. And that's a big piece. I think I find some decent value in that where, for example, Costco is a good example of this. Their model generates cash flow. So if you're looking at a company like Nike, they have to put money out to buy shoes inventory in order to grow. So if they want to sell more shoes than they did last year, they have to buy more shoes. That's working capital cash that comes out, less free cash flow for shareholders. Costco has it flipped because they sell things so fast. Their vendors actually give them the inventory and they actually sell the inventory faster than they have to pay their vendors. So that's free cash flow available to shareholders. And so when I run a model on something like Costco with a positive working capital, I tend to get a lower valuation than other models might suggest because it's looking at those cash flows. So that's just one example. But it's also led me astray. I adjusted free cash flow for Target back in 2021 because I assumed all their investments in inventory would balance out and that those would be good investments. They were not, and the stock got killed, and I took a beating on that one. So you do have to be careful on the adjustments, but you can also find value if you make intelligent adjustments, I guess, where the PE ratio might look higher, but looking at the free cash flow or the cash flow statement shows you that, hey, there might be something else going on here.
So this might be a dumb question, but when you're using that kind of model, you're not looking at the income statement as far as it impacting your inputs for the model. how do you think about, like, how do you correlate revenue growth, maybe, profitability as far as margins go? How do you, I guess, correlate those to the model? Like, how does that have any impact on what you think about the company? Because the free cash flow obviously doesn't exist if the company isn't generating revenue and is profitable. But by the same token, it doesn't really impact the valuation. And so I guess I'm curious how you think about that.
That's a fantastic question and a perfect segue. So the next input is growth rate. So just the way my spreadsheet's kind of laid out, I have revenue growth over last 10 years, operating margins over the last 10 years, and I just want to see it visually. And then I'm taking what I see in the income statement, what I see from return on invested capital or ROIC, anything I see in the balance sheet, and then putting all those together to make a growth rate number. And so some of the, I don't know if shortcuts is the right way to do it, but some of the base assumptions I make, which make that process a lot easier, is I'm assuming margins stay the same for a 10-year period. So they can improve, and they have improved. Obviously, you buy stocks where the margins improve. But I don't want to bet on it. I want that to be icing on the cake. Well, sometimes I make an exception, but let's just say for the majority of cases, okay? Operating margin, we're assuming is going to be the same. The other thing is I'm, again, 90% of the time I'm looking at ROIC higher than, let's say, 15% or 10%. So that weeds out a lot of the companies that you don't realize they're actually not that valuable until you run a free cash flow of the firm model, look at the way they reinvest, and you're like, oh my goodness, this is not sustainable. Like they're growing and they're burning cash, and it's just not going to end well. By not even putting those companies in the basket, I eliminate a lot of that, which would potentially trip me up if I wasn't, because the model's not thinking about it, basically. So those are the two of the big assumptions or shortcuts or filters that I'm using that is not free cash flow, the equity necessarily branded, but is an Andrew brand that, in my opinion, helps me mitigate some of the downsides of focusing so much on free cash flow and trying to come up with a growth rate without getting too nitty gritty into reinvestments.
Does the growth rate that you're looking at, does that correlate with revenue growth rate or free cash flow growth rate?
The growth rate for the model is based on free cash flow.
Okay.
So for me, I'm basically, I take a revenue growth rate, any additional growth from buybacks, and that's it, because I'm assuming a flat margin all the way through.
Okay. All right. That makes sense. Again, as a more of a novice with this kind of model, how do you measure any sort of reinvestment?
Yeah, that's another good question. So part of it is baked into the free cash flow side of it. So when I normalize working capital, I try to look at historically how much has this company needed in working capital to grow. So again, to steal from Professor Damodaran, if historically a company's needed 4% of working capital over a 10-year period to grow, then I'm going to model out that for a particular growth rate. And so I probably don't talk about this enough in the write-ups, but if you look closely enough, you would see it. But if there's a higher growth rate that I'm estimating, then I'm putting a lower free cash flow in the model. So when I have a range of two different growth rates and two different free cash flow numbers, that's why you see the differences. So, you can't have your cake and eat it too. Either you have more free cash flow for shareholders because you're accepting lower growth, or you need to reinvest that. And so if I'm assuming a higher growth rate on the revenues or the free cash flow, then the free cash flow number input is going to be lower to account for that.
Okay. That makes sense. And I think that's pretty smart. So you mentioned buybacks. That's not something I play with much. So what are your thoughts on that and how it impacts your model?
It can impact my model quite a bit, and it probably makes me lean more towards companies that buy back than not.
Mm-hmm.
And so in the model, this is where return on invested capital comes in. I have it baked in where it shows me a general estimate of how much cash is left over for shareholders after they do the reinvestments. And then we're going to assume that that could be used for buybacks. Not that it's going to be, but that it's available. And then that can help increase the growth rate of whatever I'm looking at.
Okay.
That's the basics of it. I try to not let it get too high.
Mm-hmm.
So I won't say like, oh yeah, 6% growth a year from buybacks. That would be pretty insane. It happens, but yeah, not going to plan for it. And so, but giving that wiggle room helps me find like a Dick's Sporting Goods, for example, where the revenue growth, if you think about, okay, they have a lot of stores, maybe it's saturated, maybe the revenue growth is not as high as it used to be. So a lot of people will value that lower, but because they have a high ROIC and I'm seeing a lot of free cash flow available, that if they don't want to grow revenues, they can just buy back shares. And that's where my valuation model can sometimes be higher than somebody else's.
Mm-hmm. Yeah, that makes sense. All right. Okay. So now that we've kind of, I feel like, laid the groundwork for DCF models and especially how you use the free cash flow to equity, let's talk about the questions. So the question was, how do you deal with stock-based compensation in your DCF? Do you project free cash flow margin expansion or use the current free cash flow margin? So this is a great question from Steven. So maybe before we dive into that, when he's talking about stock-based compensation, what is he referring to?
Yes. There's a line item on the cash flow statement that's called stock-based compensation. And man, I don't know how to not get into the nitty-gritty on this, but like, how would you describe it on the income statement? Like, help me out here.
The way I think about it is it's an expense that the company uses to help motivate and pay and incentivize their employees.
Hmm.
And what they're doing is they're giving them, depending on how it's structured, shares of the company for a certain price. Sometimes it's something they have to earn. Sometimes it's the opportunity to go buy it in the market at that price. It just kind of depends on how each company sets it up. But generally they consider it a air quote non-cash expense because it's not necessarily money you're paying out right away, but it's money that the company will owe to the employee at some point. And so that's how I look at it.
Yeah. And to that point, that's a great explanation. Thank you for keeping it English.
You're welcome.
A lot of them will quote unquote pay for it at the end by buying back shares later to offset it. And so even though a company might not be a buyback type of company, a lot of them will still buy back enough so that they're making up for that without diluting everybody else.
Right. A couple things to keep in mind when you're thinking about stock-based compensation and its impact on the financials. Number one is it includes all the peasant employees, if you will. So it includes basically everybody, but it also includes management in that. So that's all wrapped up into that. And then the other part of it, like Andrew was saying, is that companies will put that on their books as money they owe, but then they try to offset the impact of us as investors by buying back shares. And what they're really trying to do is offset the dilution. So when they give stock-based compensation to anybody and they exercise their right to own those shares, now the piece of the pie has gone from 10 pieces to 11 pieces, which means that all of us get less of the company. And so the companies know this. And so the way they try to offset it for shareholders is by buying back shares. So even though they gave Andrew an extra share, they buy back another share. And so instead of it being 11, it's still 10. And so instead of it going down to 9, it's still at 10. So it stays even. And probably the best example of this, if you want to see this kind of play out in a financial statements, is go to Meta's financial statements, because they spend a lot of money buying back shares, billions buying back shares, but they also offer a lot of stock-based compensation. And so it really just, for the most part, just offsets each other. Google is guilty of this as well. It's very prevalent in the tech space. You're not going to find this on Berkshire Hathaway's statements. You're also not going to find much of this on like a Costco or, an O'Reilly or something like that. This is more in the, faster growing sector, if you will, tech, anything related to AI, biochemistry, biotech, those kinds of things. You'll see a lot of that, but like the boring, air quote, boring manufacturing companies, nah, not so much.
Yep. That's good clarification.
All right. So how do you deal? So now that we've kind of laid the groundwork on SBC, or stock-based compensation, how do you deal with it in your DCFs?
Yeah. I mean, you certainly do want to deal with it because, like you said, I mean, they're going to have to pay for it. The cash flow statement's weird. It's interesting because it has 3 sections. And so, yes, technically, if you're going by the book, the stock-based compensation is not being paid, quote unquote, from the operations. But like Dave said, they're going to pay for it from financing activities, which is another part of the cash flow statement. So if you're really thinking about it logically as a rational investor, when a company creates free cash flow, how much is available to me as a shareholder that they could potentially give back to me or reinvest in the business to grow themselves? If there's a bunch of money that has to go to buybacks for us to break even on the dilution, that's realistically not money that was ever going to go to the business. Sure, the number is in the cash flow statement, and I'm getting a little bit riled up because it blows my mind how much people want to argue about this on Twitter. Yeah, technically the numbers on the cash flow statement, but they're gonna have to pay it. Otherwise, you're gonna see that pie go from 10 to 11 to 20 to 30 to 50. And oh, by the way, do you know what that does to your stock price? You can look at Square or Block as an example of what can happen to your stock price. So that definitely needs to be accounted for. The way I try to keep it simple. I looked at the S&P 500, took just like a big picture average. Most of them are somewhere around 4% of cash from operations is stock-based compensation. So if a company like Alphabet is higher than that, let's say 20% of their cash from operations is stock-based compensation instead of 4%, that's 16%. I'm just saying, nope, that's not free cash flow. That doesn't get to go into my model. And I just do that with every company. And so that, yeah, it's conservative. Yeah, it's pessimistic, but I also think it gets me out of a lot of potential dilution trouble or a lot of situations where like, wow, this company's so profitable, but how come the shareholders never get anything? Well, you need to look deeper at the cash flow statement. Right. So that's how I deal with it. How about you? I mean, you got your model as well. How do you look at it?
There's 2 basic ways. There's the easy way, and then there's a super complicated way. The easy button method is I subtract it from the free cash flow. So when I'm calculating free cash flow, like you said earlier, you take operating cash flow and you subtract capital expenditures from that. I also subtract stock-based compensation from that. So because what's happening is on the income statement, it's expensed out as it's considered an expense. But on the cash flow statement, because that's the actual money going in and out, and the money isn't spent, then they add it back as a non-cash item on the cash flow statement. So it artificially boosts the cash flow of a company. And this is maybe not quite as evident as some of the examples we were showing, but sometimes you can look at some very unprofitable companies and then they're bragging about being cash flow positive, and you look at their cash flow statement and you see that, yeah, they're generating 10 billion in free cash flow, and 9 of it is stock-based compensation. Like, okay, yeah, oh, sure, you betcha. So the easiest way I can explain this is that is money that you don't own, and if you go and spend it, and then you don't have it, because when somebody comes asking for their, to redeem their stock-based compensation, and you don't have it, now you owe them money, and so it's not your money to spend. So it's not. That's my argument, that it's not cash flow. Yeah, you can set it aside all you want, but if you put it in the cash flow statement, it's not actually cash. You and I can't go spend it because it's not our money. And that's how I try to compensate for it. The other way that you can do it, and I feel like that's pretty easy, and it knocks out a lot of the problems of dealing with it. It's just, okay, we're done. It's not it's not cash. I'm taking it out. It's an expense, and just call it that. I guess there's another way I was thinking about. The other way you could do it is, and this is a little more convoluted, and I haven't done it yet, but I read a paper that Michael Mauboussin wrote, and he talked about basically reconfiguring the cash flow statement and putting line items in the sections he thought it really should go in. And so one of the ways that he would do that is he would move stock-based compensation from the operations of the business to the financing of the business. And then he would move something from the financing, I think it was capital expenditures, he would move that back actually to the operations of the business. And he said those adjustments make more sense. That's one way you could go about doing it. And the third way is, I'm not going to go into the nitty gritty because that's way too much math and I don't want to put people to sleep, but Professor Demoterin has this great Black-Scholes model that he uses to calculate the value of the stock-based compensation. And then after you do all the voodoo to figure out what the enterprise value of the company is, then you just subtract that amount from the enterprise value and you divide it by your shares, and voila, you got a stock price. But that's a way you can do that as well. And he has that built into his free models that you can download from his website. And that's one way to do it, but it's a little more convoluted. That's kind of how I try to approach it. I'm curious, I've heard some people say this, and I wonder what your thoughts are. Some people have argued, I've seen them argue, that some companies will list basic shares and then diluted shares outstanding on the income statement. Do you think that is a way that you could maybe account for stock-based compensation when you're trying to value a company?
Yeah, potentially. I mean, I've just, since the beginning, always defaulted to diluted shares outstanding. Because that's assuming that the stock options get exercised.
Right.
So I think a lot of financial websites kind of default to that. Mm-hmm. So hopefully most people are using diluted instead of basic, but people are funny. They'll do whatever they can to make the numbers look nice to them, right?
Yes, they will. Several things about a DCF that you have to keep in mind. Number one, they're all estimates. Other than some of the factual numbers that you can plug in from the statements, when you're thinking about a growth rate, whether it's for revenue or for free cash flow, it's an estimate. You have no idea what's going to happen next year or 10 years from now. It's their estimates. Arguing about different rates and whatnot, I think kind of misses the point of what DCFs can offer you. And what they really, really offer you, other than the ability to try to estimate a price, is they offer you the ability to think very deeply about a company and why those inputs matter. And if you don't understand the operations of the business, there's zero chance you're going to understand its working capital needs. Andrew was talking about Costco and inventory and shoes and turnover. If you don't understand those things about Costco, all that stuff's going to go flying by you. And so that's where the DCF really offers you the opportunity to do some due diligence and deep work on why this company is a great investment and why it's not. And it goes way beyond just plugging numbers in and spitting out a result. Because again, going back to Costco, if you don't understand the cash conversion cycle of the company, in other words, how quickly they can turn the money over that they are receiving from the customer to pay their vendors, that's one of the things that sets them apart from other big box stores is, like Andrew said, most vendors will give them 30, maybe 60 days to pay the bill for buying those shoes. And if Costco can turn those shoes faster and sell them in 30 days or 20 days, then that means there's 10 extra days of cash that they can use for something else. And so that just makes them that much more profitable. And that's, to me, that's what a DCF allows you to do, is it helps you understand all those things.
Oh yeah, totally. I mean, that and even more. Like, you can read about riding a bike, you can watch videos about riding a bike, but there's nothing like getting on there and trying to ride a bike yourself. That's the same with the financial statements. I feel like you can look at the numbers, but until you actually start plugging them in, you might not fully comprehend what's going on.
Right. Exactly. Yeah, exactly. And, kind of going back to the stock-based compensation quickly, depending on the company, it can make a big impact on the value of the company if you don't account for it. And if you don't account for it, if you choose to just ignore it, especially for some of these very big tech companies, or maybe not big tech, but smaller tech companies that are growing really fast, if you don't account for that, it could end up biting you in the butt. So it is something you need to pay attention to. Yeah.
I can't remember which SaaS company I was looking at, but I wrote about, hey, here's a huge warning sign. The amount of stock-based compensation is ridiculous. They better keep growing and they better not stop. Otherwise, that's going to catch up with them.
Right. Yep, exactly. Bottom line, it is an issue and it is something you need to think about. And Andrew and I have obviously stronger opinions about our particular way to do it. But I think you can look at both sides and to try to decide. I think our way is the best. And I would encourage you to do it that way because it builds in a margin of safety for any investment. But bottom line is be consistent. Don't adopt one way for one company and another way for another company just because you want to, you like this Kool-Aid better than that Kool-Aid. That's going to lead to heartache and trouble.
Very well said.
All right, folks. Well, with that, we will go ahead and wrap up our conversation for today. I want to thank Stephen for sending us a fantastic question. If you guys have any questions you'd like us to answer, please reach out to us at newsletter@einvestingforbeginners.com. The link is in the show notes. You can send us any questions there and we'll go ahead and answer them on the air. You can also reach out to us on Spotify. The podcast app has the ability to ask us questions, so we can do it that way. Or you can reach out to us on socials, in particular on the X machine. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to y'all next week.